Hey guys, welcome to the YouTube channel. Brian's here. On Monday, January 8th, 2024, I opened a 2 DTE Iron Condor. So my expiration was for this Wednesday. This is where I opened the Iron Condor, and within the same day, things did not go well. I made an adjustment for this day. I rolled the put side up and I turned the trade into an Iron Butterfly. That is one of the textbook adjustments to make to Iron Condors where things go wrong. I held the trade for a couple days, and then by the Wednesday, the trade ended up being profitable. I'm going to walk you guys through why I opened the trade, the reasons behind why I chose that adjustment, as well as show you guys my P&L throughout the duration of the trade. What we're looking at is the SPX on the 15-minute time frame. This is my preferred time frame for intraday trading. I'm actually going to turn on the levels. So this is just demonstrating what the Iron Condor looked like. I took the liberty of doing this because I figured it would make it a little bit easy to visualize what I was thinking. This was my entry right here. This was my short put, and this was my short call. And then these were the long strikes. So that was my long call, and this was my long put. At the time in which I opened the trade, I figured the SPX had already made a decent rally to start the week. So from the low of day to the high, the market was already up 31 points, or about 68%. If we're thinking about it from a net change perspective, so last week Friday's close to where the market currently was, it was up 0.73% or 43 points. I figured at this point that was about an average, strong rally that we'll see in the market, especially since there wasn't any type of significant pullback. On top of that, the SPX was at the max pain strike for the Friday expiration. If you don't know what max pain is, just know it is a strike that acts as a very strong support and resistance level as well. And if you are aware of the max pain theory, then you'll know that it states that the max pain strike will tend to act as a magnet for price. As you guys can see, the next day, price did come back down to that max pain strike. However, on Monday, obviously there was no way for me to know what was going to happen the next day. This is exactly what the Iron Condor looked like at the time of open. So you guys can see here, this is the short call, this is the short put, this is the long call, and this is the long put. So this is the wing here, and then this is the other wing here of the Iron Condor. The Iron Condor is made up of two credit spreads. So it is a call credit spread, meaning you are shorting a call that is more expensive than the call you're buying. So you are collecting a credit on the call side, and then you are selling a put credit spread. So I'm selling the 4,700 puts because it is more valuable than the 4,685 put, and I'm also collecting a credit on this side. The combination of those two is what creates an Iron Condor. So it is two vertical spreads, or two credit spreads. Credit spreads are also vertical spreads. They're just the more technical name for what type of vertical spread you're trading. So in case you didn't know what an Iron Condor is, a person will open a strategy like this if they are neutral on the markets, if they don't think price is really going to make a large move for some time, or they think by expiration, the price of whatever underlying they're trading will be within the short strikes. So in a sense, 4,700 and 4,765, as you guys can see, this is close to the break evens here. As long as price is within the break evens at expiration, this trade will profit a certain amount. The combination of the credit received from selling the call side and the put side is going to give us a net credit. That is how much credit is being received to open this trade. The max loss is how much margin is required to open this trade. Your max profit is going to be the max amount of credit you received. As time passes by, the options that are sold depreciate in value, and that is how you profit on an Iron Condor. At the time in which I opened this trade, the SPX was about 47.30, 47.31, so just right within the middle of the Iron Condor. I shorted a put that had a delta of about negative 0.23, and then I shorted a call that had a delta of about 0.21. So that is my puts delta, and this is my call delta. If you guys have experience trading Iron Condors, you know this is not really that wide of an Iron Condor, so the probability of profit is not as high as some people might sell a call and a puts that have a deltas closer to 12. Some even run deltas closer to 10, and some will even sell options with a delta of about 5. So if you're selling Iron Condors with this type of delta, you guys know your probability of profit is very high, closer to the 88 to the 95%. However, you're not really receiving a lot of credit. Whenever I can, I like to run iron condors where I can receive a little bit more credits, even though the probability of profit is lower, as I'm expecting to make some sort of adjustments, or I'm using some sort of other edge in which I don't think price is going to make a large move. As stated earlier, the iron condor was a 2 DTE as I was using the Wednesday expiration. The wings of my iron condor were even on both sides, so it was 15 points wide on both sides. As you guys can see here, it is a balanced iron condor. The only thing that makes this probably a little bit unconventional is the fact that my deltas are pretty high for the type of iron condor in which I'm running, and my DTE is pretty short. Now that you guys have seen the risk profile, hopefully that provides a little bit more context. This is the range of the iron condor right here, and this is the expiration on the Wednesday. I chose these strikes because at this point, I had enough reasons to think that the SPX would not go back below these major strike prices here. I'll show you guys in a second what I was looking at. So I decided it would be safe to short this put, which was the low of day strike, and this was a high gamma exposure strike. So I had a lot of confidence in selling this 4,700 strike. I then shorted this 47.65 call, understanding there was a lot of gamma exposure up at that level. However, for those of you that have watched many of my other videos, you guys know I'm the lead developer at Quant Trading App, so I do use additional tools, which I will demonstrate for you guys here. If I were to turn back on my studies, this is what's referred to as the Quant Trading App weekly sell zone. So I had some faith in understanding that this level should act as some sort of resistance if price did get up to this range. As you guys can see here, the markets did end up rallying straight into power hour and ended up closing right within the Quant Trading App sell zone. I sold the call that was right at the top of the zone because I have an understanding of how these levels work. It obviously did not feel good to see that price continue to rally straight within the sell zone within the same day. That is not what I was expecting. If we take a look at the Quant Trading App Discord, this is right as I shared the trade here at 1 p.m. Eastern time. You guys can see here, I said I might have been a little trigger happy right now, but I just opened up this 2 DTE Iron Condor. I knew at the time in which I was opening the trade that I was being a little bit trigger happy because this is not the time in which I really like to open up iron condors. It's very early in the day. On top of that, this was the break of a downtrend and momentum was kicking in. You never really want to open up a non-directional spread when you see momentum. This is a strong trending day. You're better off waiting until power hour. So if I waited until here to decide to open the iron condor, I would have had a different structure behind the iron condor. So I opened it earlier in the day than I normally would open up a swing trade like this. On top of that, I was opening it without the market showing that it had established any type of range. What I mean by range is, let's just say this is a trending day and the market trends all the way up. We don't know at this point where the high is because it's still breaking out. It's still continuing to go higher. It's not breaking out a previous major swing low. So if we zoom into this day, when I say swing low, I'm referring to just the intraday price action. This was a rally and this was a pullback. It barely pulled back to this low here. Then it rallied again and then it pulled back. It did not come back to this low right here. Then we rallied and we pulled back, but it did not come back down to this low right here. Then it rallied, it tried to pull back. It did not come back to this low right here. So these are steps in a sense for price just continuing to go higher and higher. It's only if price comes and breaks back below one of these pivoting areas, then I would say, okay, now we're establishing a range, because this would be what I would determine as the high. And then I would say whatever is where it started, the trend started, that would be the low. In this case here, you guys can see there was no real pullback. It just continued to go up. It wasn't until Tuesday on this gap down, as you guys can see here, now we have a range that's established. This would be our high and this would be our low, thus making it a little bit safer for an iron condor, or at least the criteria I look for. I'm actually intending to do a video on Friday, a 0 DTE iron condor, a little bit later this week, in which I will demonstrate to you guys an example of that. This was a high of day, this was a low of day, and at this point I was considering an iron condor here for 0 DTE, because this is the high, this is the low, we have a nice range established, prices within the middle of the range. When momentum is now starting and kicking in and a trend is now forming, especially after the break of a previous trend. So this was a previous downtrend. Price is now breaking out of that trend. This is not the time you want to open an iron condor. I did a video on the gap up on this Monday here. It was a gap over the 2-day anchored VWAP. And then I discussed the momentum on this day, and I will leave a link in the description if you guys want to check out the review on Monday, as I did run a 0 DTE broken wing butterfly that had no upside risk. So I did profits on the 0 DTE, but my swing trade is what was now in trouble. That was the reason behind why I mentioned that I was a little trigger happy, meaning I was a little excited to get right back into another trade, and that's not necessarily good. Sometimes you want to wait for your conditions to hit. I was aware these were not my ultimate conditions for an Iron Condor. However, if we take a look, this is what the chart looked like. So I'm going to make this full screen just so we can really observe closer here. This is what price action looked like. This is that max pain strike. So 47.30 is the strike in which I'm aware of as max pain. This is the sell zone right here. So I was just pointing out to the other members within Quant Trading app the reason why I'm using those strike prices. It's pretty self-explanatory. Here's 4,700. It is right around last week's close. It is right at the low of day today. And then this is why I'm shorting this call up here. It is right above the Quant Trading app weekly sell zone. On top of that, I knew these were significant gamma strikes right here. So I had some extra faith in that price will meet some sort of resistance up at these levels. And if price was to come back or consolidate, it should consolidate around this blue strike right here. That is a significant edge that I use for trading. I take a look at options levels, more specifically gamma exposure levels, whenever I'm making my decisions behind what type of option strategy I'm looking to implement. Now, a couple hours after opening that trade, as we can see right here, 4:39. So this is about 20 minutes before the market closes. This is the Iron Condor's risk profile. And within the same day, that position is in trouble. Let me just make that full screen for you guys so we can also take a look. Here we have it. I ran 4 lots of this Iron Condor. So whenever I share the risk profile, I'm showcasing things. I'm just showcasing it in one lot because it makes it easier for other traders to understand. It makes it a little bit easier for me to quantify my performance whenever I do my quarterly review of my trading. And then it also makes it easy for any trader of any account size to be able to scale up or scale down according to your account size, especially if you're now starting out to learn this type of trading. And that's the main reason in which I share my personal trades, is to help newer traders leverage the experience that another trader might have. So in this case here, you guys can see what type of pain an Iron Condor like this can suffer. I was down $640 at this point. So about 20 minutes before the market closed, about 2.5 hours after I opened the trade, I'm down 600 and change. The total amount of margin being used on this trade is $4,000, as you guys can see right here. Or if you guys remember the risk profile that I shared at the beginning, this trade cost in margin about $1,000 per unit. I was running 4 of them, so therefore the max risk is $4,000, or the max amount of margin that I'm using is $4,000. So to be down $640 on $4,000 is 16%. That was my drawdown. So I'm down 16% of the margin being used. That is a significant drawdown for me. I generally around 12 to 14%. If I'm down in an Iron Condor, I will definitely make an adjustment. So I was aware that I was very late to the party. That is largely because of other obligations I had within the day, as well as a little bit of disbelief at the time that the market would just continue to keep going straight up without retesting, coming back to at least the 47.40 level. It never really pulled back. I decided to just leave it alone, and that's sometimes the worst thing you can do. But in this case, I was not afraid because I already knew I would probably turn it into an Iron Butterfly if the SPX made it all the way up here. The reason I had some sort of conviction, or I felt safe in this case of turning it into an Iron Butterfly, is because I understand, again, the dynamics of what happens with price action when we come to these quant trading app levels. It is very unlikely that price will rally this much on one day and then continue like this the next day. It is more likely that it will consolidate within this area. Meaning, if price made it up this high, even if it were to gap down the next day, my expectation would be at one point or another during the next day, it's going to return to this area. And then for my expiration day on the Wednesday, that is also a likely scenario. So my logic at the time was, even if we go all the way up here, price will remain in this area for at least a day or two, and that will give me enough time decay to become profitable. The Iron Condor was turned into an Iron Butterfly, and this is what my risk profile looked like right after that. So a few minutes after seeing this was just a couple minutes later, I turned it into an Iron Butterfly. this is what the updated risk profile looked like 3 minutes before the market closed. Because I realized the gains on the put side, meaning I closed out the put side that was originally shorts the 4,700 puts. I realized those gains. It bought in about $1,000 worth of profit. And then I immediately sold the 4750 puts and the 4765 put. If you guys recall, we are shorts the 4765 call. So by being short the 4765 call and then also shorting the 4765 puts, I'm now restricting the range of the Iron Condor. So if the profile before looked something like this, I've now moved this side up, pushed it all the way up to here, and now it is creating this profile that we see in the background right here, known as an iron butterfly. The reason for doing so is I'm now bringing in more credits because I'm shorting an at-the-money put. By shorting an at-the-money put, I'm going to receive a lot more credits than what the 4,700 put was going for. Because the 4,700 put is all the way back at the low of day. That put has already decayed so much as the market rallied, it was almost pointless to continue holding onto that side of the option. By making an adjustment like this, what it also does is it reduces the curve of my T+0 line. So as you guys see right here, my risk is not as high or as sensitive to price because you guys can see right here, this is the T+0 line. So this is the P&L at the time in which the screenshot was being taken. It is down $1,500, as you guys can see here. So this is down 1,000, this is down 2,000, this is right within the middle, so it's down about 1,500. However, if price was to continue rallying, let's just say it rallied another 15 or 20 points or so, you guys can see at this point the drawdown would not be that significant. It would go from maybe down 1,500 to maybe down about 1,700, 1,600. So just an additional $200 drawdown, it's not that bad. And then at the same time, if price was to retrace all the way back maybe down 20 points or so, this position would be down $200. So at this point, it doesn't really matter which, large move it makes in any direction because I've flattened my T+0 line. And whenever you're making an adjustment, that is something that you really want to look out for. You want to keep this line pretty smooth. Obviously, the entire position is going to read as if it's in the red. What this is not showing is that I realized the profit from the put side. So I've already pocketed $1,000. Therefore, I'm really only down about $500 in this position, give or take $50 or so. Which, if you guys remember earlier in the day, this is the Iron Condor. This is the P&L that position was down on, the Iron Condor. So that's the difference between when you're reading your P&L after you make this type of adjustment. Sometimes it can be a little bit confusing. You probably want to journal or archive. You can save the trade within Thinkorswim, the put side, and then you can keep that on, and that will show you a more accurate read of what your P&L is. But when I took the screenshot, I didn't do that because I just wanted you guys to see what it can look like and not to be afraid of this number here. Again, if you realize the grand from the put side, this is just reading what the current position is, which is this iron butterfly. The call side is experiencing a significant drawdown, so that's why it's going to read this way, because you just open up a fresh put credit spread. You just brought in some new credit. It's not going to be reflected in your P&L until time has passed by. There are a few other things I want to point out, but before that, I want to jump to how this ended up working out. In case this video is getting a little bit long for some of you guys, I just want to walk you through the cash flow. So the Iron Condor on Wednesday at this point ended up becoming overall green, or in this case, the Iron Fly. It was an Iron Condor adjusted into an Iron Fly and ended up overall green. $2.50 profit is what was realized from the put side of the Iron Condor. So again, we started off by selling the 4,700 put, and I purchased the 4,685 put. So that was the put credit side of the Iron Condor. On Monday, I sold 4 lots, so I collected $1K in profit. That's $250 times 4. That's $1,000 in profits. Then I rolled up the put side. So I ended up taking this put credit spread, closing it out, and then opening up another put credit spread right here, bringing in $650 of additional credits. So by selling 4 of those, you guys do the math, that's how much credit was received. Now it's going for $4.37. So it decayed $2.15 profit per lot. So I ran 4 of these, so that brought in $860 in profits. The call side, which was originally sold for $2.47, this is the call side of the original Iron Condor, is now going for $5.90. So I originally sold it for $2.45. It's now going for $5.90. So that is a loss of $3.45 or $345 times the 4 lots, which is a total of $1,380 in the red. So we just add up the total numbers, $1,000 received from the first credit spread, $860 received from the second put credit spread, and then a loss of $1,380 from the call credit spread, making a total of $480. Also want to mention, again, the total margin I used was about $4,000. So a $480 return on $4,000 in margin used is about 12%. So a 12% return on a 2 DTE Iron Condor is pretty good. The drawdown was around 15 to 16%. When you're trading these types of Iron Condors, you have to be willing to give them a little bit more room in terms of drawdown relative to how much you're looking to make. So if you're looking to make 10%, sometimes you need to be willing to give the trade a 15, possibly even a 20% drawdown, because it is the nature of credit spreads, specifically Iron Condors, how they work. Again, if you're looking to make 10%, sometimes you need to be willing to have it draw down 15 to 20% if you're looking to make your profit target. You're waiting for time to decay and time to pass by. That is something you have to consider when you first open the trade. So if you're spending $4,000 or using $4,000 of margin, what is a 15% drawdown of that margin or that amount of capital? If that number is too high for you, then $4,000 is too much risk. You need to reduce your size. Maybe run an Iron Condor using just $2,000 in margin, because at that point you can maybe say, hey, you're willing to have a 20% drawdown. That is something that might fit your account size. A 20% drawdown on a $2,000 position, you can give the trade some room to breathe, and you won't be panicking because you're not going to see that you're down $1,000 or something too high. You can very comfortably hold to let the trade work out, because at the end of the day, Iron Condors are high probability of success type of trades. The thing that's not often discussed is the duration of holding the trade. You will often ensue some type of pain, and there will be some type of drawdown. The key or the success, in my opinion, with Iron Condors, whether you're going really wide Iron Condors or you're going with a 20 Delta type of Iron Condor that I'm running, is how well do you manage your drawdowns. And a large portion of how well you manage your drawdown is your position size. How large are you going from the moment you actually open the trade? You need to be aware of how bad the Iron Condor can get. On top of that, having clear levels that you are aware of what you're trading. In other words, if you're using some sort of system like quant trading app, or you're using some sort of other edge, have the levels on your chart, be able to see them. This helps, in my opinion, significantly. Knowing what is at this call strike, knowing what put strike I'm shorting, knowing what the previous week's low was, understanding that this area should provide some type of support. So if the markets did reverse and came back down into this area, I would not panic, because I would be thinking this area is going to act as some sort of demand zone. I'm not going to panic, because I would be telling myself this area should act as some sort of demand zone. It should offer some type of support. That is why I sold the puts in this area, because I would expect price to come down to here and then reverse. And then by Wednesday, the Iron Condor will be totally fine. The same case here. If price was to go up, I would expect it to reject in this area. However, whenever the market is going up and it enters in strike prices that have a lot of high positive gamma, it will usually be choppy in that area. And that is the edge that I'm aware of. So if we come back up here and we see what happened later, let's just see. So yes, I just highlighted this. The reason I had that conviction, the main reason I had this conviction to hold, was knowing what usually happens around the quant trading app sell zone. Price usually sticks around here without a major catalyst. There was no major catalyst on the schedule for a couple days. Added conviction was with how high GEX was around this area. I only made one adjustment and held. So I opened the trade, poor timing. When I opened this trade, price rallies. I made that one adjustment and turned it into an iron butterfly. And then all I had to do was just wait a couple days. I also ran another trade. So this is unrelated, but this was a put broken wing butterfly that I opened on the Monday. So at Monday's close, this is the put broken wing butterfly. And this is something you can also do. You can add on another spread to whatever trading which you're already holding. The Iron Condor's expiration was for the 10th, but on Monday, January 8th, I decided to run this put broken wing butterfly. The structure of this trade, or the logic behind this trade, was, hey, the market is at 47.60. It's in this area. This area should act as some sort of resistance, as we established on the chart. So at this point, I'm not going to ignore the fact that the market might just retrace back to the max pain strike the next day, which would be the Tuesday expiration. And that is the beauty of 0 DTEs every day of the week. You can create a trade like this. My risk was not that high. As you guys can see, the debit on this trade was less than $1. So in other words, if the market was to keep running up or price just stayed around here, I was only adding $1 more in risk to my overall position. This is well within the risk parameters for myself. However, if the market did gap down and then retrace back to the max pain strike of that 47.30, the 47.20 area, anywhere within this area is what I was thinking we would retrace to. This trade can bring in an extra couple dollars in profit. And obviously, if the price pinned around here, there was an opportunity to make a lot of money. But I did not hold the trade like this for the full day. Once price gapped down and I saw that we bounced back up and we took out the high day, I decided to just realize the profit on that trade. On top of that is also having the experience to know usually after we get some sort of a rally, price will retrace about 50%. As we head back to the Quant Trading App Discord, you guys can see this right here. This is that 50% retracement side. So I use Friday's low to Monday's high, and then I figured if we would retrace, we would come right back down to 47.20. And that's why I decided to run the butterfly, targeting this area, but understanding 47.30 was good enough. It didn't have to come all the way back down to 47.20. Anything within this area, as long as it gaps down, the trade was going to be good. And if the market continued to go up, I was only going to be risking an extra $1. If price stayed sideways, then the trade might have been down maybe 20 cents or so overnight, which definitely would not have been a problem. Now back to the iron butterfly. That same day, because the market had rejected 47.65, we gapped down, and this is what the P&L looked like for that iron fly. If you guys remember this one right here, that was down $1,500. Because price gapped down, it meant this iron fly was no longer as attractive. So that's why I said it looks like I messed up with that very late in the day adjustments to the Iron Condor. I should have made this adjustment much sooner, because at this point, one can argue it was probably better if I just left the Iron Condor alone. So I wanted to share what could be argued as a mistake. This is what the Iron Condor would have been looking like if I made no adjustments or I did absolutely nothing. I just let it continue to play itself out. So I'm going to open this up and make it a little bit larger for you guys. You guys can see it was up about $1 here. This screenshot was taken 4 minutes after the market opened on the Tuesday. So the next day, right after the market gap down, it's one of the things that I really like about option strat. I can save the trade. I can put it in a closed folder. So now I'm no longer in this trade. However, I still like to go back and track to see, especially at the end of the week when I do my journal or do my analysis, or I might create a video like this. I can share with you guys, it might have been less risky to actually just let this trade play itself out, because I was already down close to what would have been my max loss. However, I know I wouldn't have slept that comfortable overnight, considering what could have happened if the markets did do the unexpected and gapped up and then continued running. You never really want to suffer a max loss. You don't even want to put yourself in the position in which you can suffer a max loss on Iron Condors. So in this case here, yes, this might have been a good idea, because this would have been the profit targets. I'm generally looking for about 20 to 25% of my credits, which usually translates to about 7 to 10% of the margin. So in other words, 10% of the margin here is about $100. So 9%, this is well around the profit targets for an Iron Condor like this, which means I would have hit my profit target one day later. And with 4 lots, that would have been about $400 on a trade that didn't even take 24 hours to hold. That is something that I also want to point out. When you make adjustments to these types of trades, it will usually mean you have to hold it a little bit longer. And that's the part that I'm usually uncomfortable with. I would rather just get out of the trade, but I'm trying to condition myself to hold the trades a little bit longer, especially if I have some sort of very strong reasons and I've done my job with managing the risk. What the market does is outside of our control. My job was to reduce my risk, and I felt I did a good job with that by reducing my T+0 line, following the rules of Iron Condor management. Even though I know now I'm going to have to hold this trade a little bit longer than I would like to, because it's going to take longer for the iron fly to have the options decay. Out the money options decay faster than at the money options. However, at the money options have a lot more premium. So even though the out the money options are decaying faster, the at the money options are a lot more attractive. And that's one of the reasons why I usually tend to trade in butterflies versus Iron Condors. even though the probability of success is much higher without the money options. I think that's for guys that only trade paying attention to their deltas. They don't have as firm of an understanding with technical analysis. They're not using something like quant trading app, or they don't understand gamma exposure, or they just don't use gamma exposure. We have so many different options for any type of edge now as retail traders than we did 5, 10, 20, 30 years ago. And I like to utilize as many of the tools possible that make sense to me. So if there's a time where I can go with at the money options to collect more credit, I would probably prefer to go with that option versus using out the money options. Even though the probability of success is higher, you'll have to use a lot more margin to receive significantly less credit. So that is the trade-off. By market close, so this is 3 minutes before the market close on the Tuesday, this was how the iron fly had recovered. So as you guys can see, it pulled in about $329 on this day. Again, the previous day it was down about 1.5. So we can see that it was recovering. That's why I just started mentioning here. We can see that it's recovering a little bit today, and the fact that it can even turn out profitable is going to be funny for tomorrow. And the following day, if we take a look at the P&L, this would be right here. So this is 10:36 Eastern time here now on the day of expiration. So this is the Wednesday. As you guys can see, the price is still chopping around 47.65. The trade pulled in another $500 just from waiting. And at this point, this is when I started submitting my closing orders. So I was taking my screenshots from my journal as well as sharing within the Quant Trading App Discord just for anyone that is curious that have not adjusted Iron Condors. You guys have asked for how I manage or, make adjustments to my Iron Condors. So I figured I'd just come in and share some of this. So that's why this was the recap, in which I shared a little bit earlier, some of my justifications, and then as well as how the Iron Condor would have performed if a person did not take profits on the Tuesday, decided to hold the Iron Condor into the Wednesday. The Iron Condor would have been down $1. So now this would have been a very challenging, decision to make what to do now with the Iron Condor. But by using the Iron Fly, it was simple to just take profits. So I was just saying, hypothetically, if I didn't make the adjustment on Monday, I would have probably just closed that one out, and then I would have run an Iron Condor on the Wednesday because of the conviction in which I would have had that price would have been choppy in this area anyway. I decided to leave the gamma exposure towards the end of this video in case it's a subject that you guys are not aware of. That way, this is a good time to probably conclude with watching this video. I want to point out the other edge that I had was gamma exposure. So if we take a look at Quant Trading App right here, the gamma exposure has been archived for almost a year and a half now, both the 0 DTE and the weekly expiration. So what we're looking at is the SPY. This is the weekly expiration on the 8th. So this was on Monday. This is what the gamma exposure was for the Friday expiration. So at the time in which I was opening, so again, this is right when I was looking to open the trade, I was aware of how much call gamma there was to this upside here. I saw how much volume was coming in. This is where I had some sort of conviction, or I felt safe around the 470 level, because I saw how strong of a level this was in terms of the volume that was coming in. It was the absolute gamma strike, it was the max pain strike, and price was above it. So whenever price is above such a strong option strike as this, my brain immediately interprets this as support. So selling any type of puts below this strike is usually the first thing I'm going to take a look at. So that's on the SPY here, and let's take a look at the SPX. This is the SPX a few minutes before I open the Iron Condor. So as you guys can see here, this gamma profile was generated at 12:51 Eastern time. It is for the 4 DTE, so this is the Friday expiration. It is the weekly. The weekly expirations are larger and they're very important. So as I'm looking at this, I shorted the 4700 put right here. This was below that 470 strike on the SPY. I start my analysis on the SPY, and then I come and take a look at the SPX to decide what strike prices I actually want to trade. Because if you guys didn't know, I do 90% of my analysis on the SPY, and then I actually trade SPX options. On the upside here, we can see this 47.65. I call this an island. Whenever there is a strike like this that is the opposite of all the neighboring strike prices, and it's pretty dominant and it sticks out, this is what I call a negative Gex island. Because it is in isolation, it is by itself. In other words, it almost doesn't even belong there. Whenever I see this, this is one thing that contributes to price being choppy around this strike price. If I was not considering running an Iron Condor, I would have considered just running an out the money long call butterfly targeting this strike price, and the expectation would be that price would rise towards this strike at one point during this week, and then it will remain a little bit choppy in that area. So knowing this in combination with the Quant Trading App sell zone is why this 47.65 strike, I didn't have any real fear or concern regarding running the Iron Condor and then rolling it into an Iron Fly, because if I wasn't running an Iron Condor, I would have just ran an Iron Butterfly anyway. Something to take note of, another thing that's pretty neat with Quant Trading app is we can regenerate all of these graphs right here. So we can see exactly what the data, what the information looked like at the time. I'm going to turn on the absolutes gamma strikes, and I'm going to turn off the net gex. And this is our spot price right here. This is a lot of absolutes gamma to the upside. This right here is usually something I will use as a gauge for some sort of directionality. My brain is going to interpret this as there's a lot of liquidity up here, and price is going to want to gravitate towards where there is a lot of liquidity. On top of that, there is a lot of speculation at this time that people are still buying a lot of out the money calls. That is going to be a sign. So this is the call volume, the put volume, which I just turned on, and we can see how strong this is right here. Relative to the other strike prices on this chart, there's nothing more dominant. The highest call volume, the second highest call volume, and the third highest call volume are all higher than the highest put volume on this chart. At this point, the highest put volume was coming into 4,600. At this point, I'm going to think someone is just selling these 4,600 puts because they're thinking there's no way the market is going to go this low. That aside, regardless of who's doing what, this is something I'm paying attention to right here. That is a lot of volume going into the upside. If we turn off all of the volume, we take a look at from an absolute gamma perspective, there's a whole lot more absolute gamma to the upside relative to the spot price. So this is our spot price. Price can either go up or it's going to go down from here, because it's not going to stay at exactly 47, 29, 73 cents for 4 more days this week. It's either going to go up, even if it goes up 1 penny or it goes down 1 penny, it's going to make some sort of move. So relative to the spot price, where is there more absolute gamma? And I'm looking at this and I'm seeing that it's all to this upside. So that was another reason in which I said I might have been a little trigger happy when I first opened up the Iron Condor. I was already aware of this. I took a look at all this and I said, hey, we're probably heading up there, so be prepared to make some sort of an adjustment. The smarter thing that I could have done is probably just grab a call debit spread, or I could have just grabbed a call and hedge myself. I could have done a better job with that instead of waiting for price to actually get all the way up to 47.65 and then doing something about it. But again, a little bit of denial, a little bit of some other obligations. I wasn't entirely focused after I opened the trade, as I like to open up the Iron Condors and step away, go grab lunch, go take care of emails or handle any type of calls or meetings at that time. It's the middle of the day, a late lunch, and that's why I don't really like to make too many other trading decisions around 1 p.m. I would much rather wait until 2:30, possibly even power hour. However, I am starting to trade a little bit more throughout the middle of the day as I'm trading less and less at the start of the day. I think waiting for more information is becoming a little bit easier for me as a trader, especially as I'm trying to trade a lot more 0 DTE and shorter DTE Iron Condors. I used to only trade 21 to 45 DTE Iron Condors. I wasn't really that comfortable trading weekly Iron Condors. Now I'm getting more and more comfortable with them because I'm improving how I manage them, as well as adding more confluences and more of an edge to the trading, and that's reducing that anxiety behind, oh my God, what am I going to do if something goes wrong? I don't really want to have some sort of a drawdown, XYZ. At the end of the day, fear is just a byproduct of not understanding or not knowing. And if we have some sort of tools or we already know what's likely to happen, that can ease the anxiety and the concern. So this is what provided some sort of an edge and context for myself here. It's understanding this 47.65 strike, how important it was. There's a lot of absolute gamma here. It was a negative gex island surrounded by a lot of positive gex. This all translates to me as price is going to be choppy within this area, and that coincided perfectly with the quant trading app script. Just going to turn the studies back on. My Thinkorswim is actually running really slow right now. I think it's in the middle of maintenance, but all right, there we go. So just turn the studies back on. So here is our quant trading app sell zone. Here is where all the absolute gamma was, around that 476 area. Here is that whole range in which I would expect price to be choppy. And then we can see price was choppy here. It was a magnet here, it was pretty choppy. Yes, it gapped down, but it just went right back to where it wants to be. And then on the Wednesday, it stayed right where it wanted to be for a few hours. So just having this information provided a significant edge. It allowed the Iron Condor to go a little bit smoother. Wasn't really that concerned. I wasn't worried. Yes, there's room for improvements, but I figured I'd share a detailed video, as I don't think I've done a video on how I manage or how I might make an Iron Condor adjustments. Hopefully this provides some insight. It is not my default or go-to strategy when I'm looking to make an Iron Condor adjustments. I won't always turn it into an Iron Butterfly, but it is one of the textbook staple ways. Or if you're now starting out with your Iron Condors and you want to know what's one way of making your adjustments, just turn an Iron Condor into an Iron Fly. You are reducing your probability of profits, but you are reducing your risk. You will have to stay in the trade a little bit longer. And then you just have to come up with an exit plan for yourself that in case price did not consolidate around here, you have to have some sort of plan for what you're going to do, for where you're going to stop out. In this case, let's just say the market did gap down and maybe all of this information in this case didn't work out and the market did not come back up to here and we just kept selling off. Then obviously this iron butterfly up here would have just been completely dead. So that's something to consider. So in this case here on the Monday, I ran a broken wing put butterfly to try to bring in a little bit of profit in case we did gap back down to here. So you consider that. You can maybe grab a cheap out the money put, and then if price gaps down, you realize the gains on that put because you're reducing the cost basis for your overall Iron Condor / Iron Butterfly. That's a little bit more of an advanced concept, I guess, but that's the approach professional traders will have if you trade at some sort of prop firm or if you trade for some sort of institution. It's all about reducing your cost basis, and that is the ultimate goal. How can I reduce my cost basis, therefore reducing my risk, to see my trading strategy play itself out. Guys, if you enjoyed this video, leave a comment down below, like it, share it, and I'll catch you guys in the next one. Thanks for watching.